The internet computer is quietly entering a new phase, one where numbers, not narratives, tell the story. For months, the project's burn rate has been climbing steadily, signaling real on-chain demand across its ecosystem. Every cycle converted, every smart contract deployed, every dApp interaction removes a little more ICP from circulation. And while most traders are still staring at the $5 price tag, what's happening beneath the surface could define ICP's next major move. Because if this burn momentum keeps building, the internet computer might be on the verge of something rare in crypto, a true shift toward deflation driven by actual network usage, not speculation. For most of its journey, the internet computer, or ICP, has been one of the most ambitious and misunderstood projects in the blockchain world. It aimed to build a decentralized cloud capable of hosting websites, apps, and smart contracts directly on-chain. But as with most bold ideas in crypto, the road to mass adoption has been far from smooth. In 2021, ICP launched with enormous hype. Its price soared above $400, briefly ranking it among the top 5 cryptocurrencies by market capitalization. Yet soon after, the market corrected sharply, wiping out more than 95% of its value within months. Critics called it overvalued, while supporters argued that the market simply didn't understand what ICP was building. This video is created for educational and informational purposes only. It does not promote or endorse any financial product, investment, or cryptocurrency. All information presented here is based on publicly available sources and independent analysis. Viewers are encouraged to conduct their own research before making any financial or technological decisions. Now, in 2025, the narrative is changing again. The focus has shifted from hype to fundamentals, from speculation to measurable network activity. Today, ICP is trading around $5, a modest number compared to its early highs. But what's more important is what's happening behind the scenes: the token's burn rate, cycle conversion, and usage growth across the internet computer's ecosystem. This is where the story gets interesting, because if the burn rate continues to climb, and if real-world usage keeps expanding, ICP could eventually flip from being inflationary to deflationary, meaning the network could start removing more tokens than it creates. And that could have major implications for its long-term price trajectory. To understand the dynamics behind ICP's price, we first need to unpack its unique tokenomics, something that sets it apart from traditional blockchain models. In most blockchains like Ethereum or Solana, users pay transaction fees directly in the native token. On ICP, the model is flipped. Developers convert ICP into cycles, a kind of internal fuel that powers computation, storage, and bandwidth on the network. Once ICP is converted into cycles, it's effectively burned, permanently removed from circulation. First, it isolates users from price volatility, because cycles are pegged to stable computing costs, not market swings. Second, it ties ICP's long-term value directly to real network demand. The more developers build and the more applications run on the internet computer, the more ICP gets burned. So, in a sense, ICP's deflationary pressure is not based on hype or staking mechanics, but on genuine usage. As of late October 2025, ICP's price hovers around $5, with a total circulating supply of roughly 539 million tokens. Its market capitalization sits near $2.6 billion, ranking it in the top 40 cryptocurrencies globally. While that might seem far below its all-time highs, it's important to consider that ICP's price now reflects a much more mature stage of its ecosystem. The initial sell-off years ago washed away speculation, leaving behind developers, long-term holders, and DAO communities who are focused on building real value. ICP's volatility remains moderate compared to many mid-cap altcoins. It trades between a support level near 4.50 cents and resistance around $6, levels that have been tested multiple times this year. The asset has yet to make a decisive breakout, but trading volume and on-chain metrics suggest growing attention from both retail and institutional participants. Now let's get to the core of what really drives ICP's token economy: the burn rate. When developers or users deploy smart contracts, host web services, or interact with canisters on the network, they use cycles to pay for computation. Those cycles are created by burning ICP. The higher the on-chain activity, the greater the number of cycles consumed, and the more ICP leaves circulation forever. Recent reports from Definity's community dashboard show that the cycle burn rate averages between 400 billion to 1 trillion cycles per second across the network. To put this into perspective, 1 trillion cycles corresponds to thousands of smart contract calls, website requests, and on-chain API calls occurring in real time. According to community statistics, total burned ICP has now surpassed 2 million tokens, and this figure is accelerating each quarter. That might not sound massive yet, but the pace matters. In 2023, the burn rate was roughly 1/5 of what it is today. The trend is clear. Network usage is expanding and burn is rising with it. ICP's tokenomics follow a delicate balance between minting and burning. New ICP is minted regularly to reward node providers who supply computing resources as well as participants in the governance system, known as the Network Nervous System, NNS, who stake their tokens to vote on proposals. To reach a neutral supply state, where the number of tokens burned equals the number minted, the network would need to burn approximately 69 million ICP per year. Currently, the annualized burn rate is estimated to be around 10 to 15 million ICP, meaning the supply is still expanding slightly. However, this gap is closing as on-chain activity increases. If adoption continues to grow, the tokenomics could eventually flip into a deflationary phase, something only a few blockchains in history have achieved through organic usage rather than artificial burning mechanisms. This potential transition from inflationary to deflationary supply is the key reason many analysts are beginning to re-examine ICP's long-term value proposition. Why burn rate matters more than price charts? In most cryptocurrencies, traders fixate on short-term charts, resistance levels, RSI, moving averages, and so on. But for ICP, those indicators only tell half the story. Because ICP's value is inherently tied to network usage, burn rate is the most accurate measure of organic demand. It reflects how much real computation the internet computer is processing. Every time a dApp performs an action, whether it's storing a user's post, hosting an NFT collection, or running a back-end API, a small amount of ICP is removed from circulation. This makes ICP one of the few projects where price appreciation naturally aligns with ecosystem growth. More developers mean more cycles burned. More dApps mean higher usage. Higher usage means lower circulating supply. If that trend continues over time, scarcity could start exerting upward pressure on price, independent of speculation. It's worth remembering that ICP's story didn't begin with strong token economics. When it first launched, the narrative was dominated by speculation and controversy. Critics pointed to the rapid token unlocks, confusing distribution model, and massive initial valuation. But in hindsight, that period looks like a typical early-stage correction, one that almost every ambitious crypto project goes through. What sets ICP apart now is its slow but steady pivot from speculation to substance. Since 2023, Definity and its developer community have made measurable progress. The chain key cryptography upgrade allowed direct integration with Bitcoin and Ethereum. The SNS, Service Nervous System framework, enabled full DAO launches on-chain, with dozens of decentralized applications now running without external infrastructure. The ICP dashboard began publishing live data on cycles burned, tokens in governance, and subnet performance, creating full transparency into token flows. All of these developments feed into the burn mechanism. Each deployed SNS DAO, every new application, every user transaction, they all require cycles, and those cycles require burning ICP. That's why analysts are watching burn rate more closely than ever before. It's not just a number, it's proof of life for the internet computer economy. The economics of usage growth. Let's break down what happens when ICP adoption grows. Developers convert ICP to cycles, locking in computing power. Cycles are consumed as users interact with dApps or services. ICP supply decreases permanently through burning. As supply falls and demand rises, market equilibrium shifts upward, potentially pushing prices higher. This is a self-reinforcing cycle, but it depends entirely on real demand. Unlike projects that artificially reduce supply through token burns or buybacks, ICP's burn process is purely functional. Tokens are burned only when they are used, meaning each burn represents real economic activity. That's a sustainable foundation for value creation. According to the latest metrics from dashboard.internetcomputer.org, daily canister calls have been increasing steadily throughout 2025. ICP now supports thousands of active canisters, essentially smart contracts, and more than 100 decentralized applications across DeFi, social media, and gaming. Popular dApps like OpenChat, DSCVR, Finterest, and IC Lighthouse continue to attract users and developers, driving consistent network activity. Additionally, the integration of chain fusion, ICP's method of interacting natively with Bitcoin and Ethereum without bridges, has opened entirely new use cases. Projects are now building decentralized finance, DeFi products, that settle directly in Bitcoin while running fully on ICP's infrastructure. Each new integration and user interaction adds to the cycle burn rate, which in turn affects token supply. Becoming deflationary is not a simple switch. It's a process that unfolds as adoption scales. For ICP, that process depends on three core variables: total ICP converted into cycles, burned; total ICP minted for rewards and governance; velocity of network usage growth. If network usage doubles while reward issuance remains constant, burn will start catching up to minting. At some threshold, supply growth hits zero, and beyond that, the network becomes deflationary. Based on current projections, some analysts estimate that if cycle burn rates sustain above 3 trillion cycles per second by mid-2026, ICP could approach a neutral or deflationary state. That's an ambitious but achievable target given the ecosystem's momentum. Once deflation begins, the economics shift dramatically. Every additional cycle burned reduces supply in a system where demand for computation continues to grow. That's how scarcity-driven price appreciation happens naturally, without manipulation. From a market standpoint, ICP remains one of the few large-scale blockchain projects with a functional, built-in burn mechanism tied directly to computing usage. Traders who focus purely on charts often overlook the significance of this model. The price might fluctuate day to day, but behind the scenes, tokens are constantly being removed from circulation. At the same time, staking and governance lock up a substantial portion of ICP supply. According to data from the network nervous system, roughly 60–70% of ICP remains locked in neurons, meaning these tokens are not freely tradable. That reduces circulating supply even further and stabilizes price volatility. If burn continues to rise while locked supply remains high, even small increases in demand could translate into significant upward movement over time. Comparing ICP with other Layer 1s. When comparing ICP to other smart contract platforms, one thing becomes clear: its economic model is more utility-based than speculative. For example, Ethereum became partially deflationary after the EIP 1559 upgrade introduced gas fee burns. But Ethereum's burn depends on transaction fees, not computational usage. ICP, on the other hand, burns tokens for every unit of computation, making it more directly linked to network performance. Solana, Avalanche, and other L1s also have burn mechanisms, but none are tied so tightly to real computing power. This gives ICP a unique position. Its token value grows in direct proportion to internet-scale usage. Of course, ICP's deflationary model relies on significant developer adoption, and that takes time. Competing ecosystems like Solana, Base, and Arbitrum have large user bases and faster liquidity flows, while ICP's ecosystem is still growing. Moreover, ICP's technical architecture, though powerful, is complex for newcomers. Developers must learn new tools like Motoko and the Candid interface, which can slow onboarding compared to EVM-based systems. Then there's the issue of perception. Despite major technological progress, ICP still battles the stigma of its rocky early launch. Overcoming that narrative will take sustained results, transparent data, and continued community engagement. Yet for long-term investors and builders, these challenges also represent opportunity. As market sentiment shifts and usage grows, those watching the fundamentals, like burn rate, active canisters, and governance activity, are likely to see the turning points before the broader market does. So, where could all of this lead? If the internet computer continues on its current path, with burn rates climbing, token supply tightening, and ecosystem adoption accelerating, the long-term price outlook could improve significantly. A deflationary ICP would mean each remaining token represents a larger share of a shrinking total supply. Combine that with real usage growth, and the value proposition becomes compelling. On the other hand, if burn stagnates or adoption plateaus, inflation could persist, keeping prices subdued. It all comes down to whether ICP can convert its technology advantage into sustained network demand. Right now, the indicators are leaning positive. The network's transparency, governance model, and seamless integration with other chains position it well for the next wave of decentralized infrastructure demand. ICP's journey from speculation to sustainability is a story of evolution. What began as one of the most misunderstood projects in crypto is gradually proving its model through measurable data, and the burn rate is the clearest evidence of that progress. At around $5, the token may not look glamorous compared to its early hype days, but behind that modest price lies an expanding network, rising burn numbers, and a clear path toward deflation. Whether or not ICP becomes fully deflationary in 2025 or 2026, the direction is clear. More usage equals more burn, and more burn equals less supply. For a blockchain built to host the open internet itself, that's not just a technical milestone, it's an economic one. And that's the quiet shift happening inside the internet computer, where value isn't driven by speculation anymore, but by the simple equation of supply, demand, and usage at scale. All right. If you learned something new or enjoyed this video, make sure to hit that like button, subscribe to the channel, and turn on the bell icon so you don't miss future updates. The market moves fast, and we'll be here breaking it all down for you every step of the way. Thanks for watching, and I'll see you in the next one.